Save hundreds of dollars on your mortgage payment for the first 2 years with a 2-1 buy down. Now, in a couple of years, interest rates are going to be going down. But until then, what's someone to do? So a 2-1 buy down, I've got some numbers on the board back here that I'm going to go over, can really help you get into the home and have a lower mortgage payment. In this case of a $400,000 loan, it saved over $500 a month for the first year. Check it out. Okay, so here we've got a $400,000 house, $400,000 loan at 7.125. Let's say that that's the rate, okay? That monthly principal and interest only payment is $2,728. Now, year one, you've got 5.125. That's what the 2 means. The 2 means 2% down from the start rate of the 7.125. So year one at 5.125, we've got a monthly payment of $2,208. Now that saves over here $520 a month. Oh my gosh. Now, what happens in year two? Let's go back here. So year two, we go up 1% to the 6.125. Hence, again, why it's called a 2-1 buy down. Now in year two, the 6.125 has a payment of $2,462. Now remember, this is principal and interest only. It does not count any tax, property tax or insurance, okay? So this savings in year two is $266. Now, I don't know about you, but this is a lot of money. So over the course of time, it can really add up. Now, you're probably wondering, okay, what's the catch, Jennifer? How is it paid? So rewind to the closing table. At the closing table, a seller credit, this has to be paid by the seller. A seller credit goes into a lump sum. It's sent to the lender to an escrow account. And every month, that money, that $520 the first year, and then the $266 a month the next year, is actually extracted from the escrow account to help make the full payment, okay? So down here, we've got $520 times 12 months. That's equivalent to $6,240. So year two, it was $266. So we've got $266 times 12 months. That cost of that interest deficit is $3,192. So if you add these two numbers, you're left with $9,432 that is paid by the seller. So that money is collected at closing in the form of a closing cost in the lump sum. Now here is the really cool thing. So let's say the $9,400 is on deposit with the lender. It's been reducing every month, month 1, month 2, month 3. Buyer is saving money. Let's say that in 18 months, rates could be in the 4% again. Whatever balance is left in that escrow account, remember that $9,432 has been reducing every month to pay for that deficit in the payment. But let's say that there's $3,000 left in the account at the time of refinance. That $3,000 will be applied to the principal balance. So it's not a use it or lose it type scenario. It actually will benefit the buyer if they get out of that loan before the 2 years is up. The money that is left in that escrow account for that initial deposit from the seller, that money will actually benefit them by reducing their principal. This is a really great product, y'all. It actually can benefit the buyer better than taking $9,400 and buying down the interest rate. This way, it's a lot better to use this money to buy down the monthly payments for 2 years. Talk to me about it, DM me, email me, whatever, however you can, loanwithjen.com. Happy to explain it more and see how that can pertain to you specifically. Peace out.